In this episode, I'm talking to Lee Hartley, founder and CEO of Fairstone. Fairstone is a privately owned, full-service wealth management firm. Fairstone has an annualised run rate revenue of $120 million for 2022, has $15 billion of client investment funds, and employs over 1,100 people. Lee and the team at Fairstone's aim is to bring intelligent wealth management solutions to their clients across a lifetime financial journey. Lee founded Fairstone in 2008, growing the business from startup to a market leader. Lee has been integral to Fairstone's growth, leading the business through a series of investment rounds and overseeing the development of the business strategy and national acquisition program. Hi Lee, welcome to the Zeus Founder in Chief podcast. Very grateful for you joining us here.
Morning, Paul. Thank you very much for inviting me.
No problem at all. You didn't start out in financial services. I'm quite interested to your journey into starting out financial services and wealth management businesses.
Yeah. So I always say, I've never sat any financial planning qualifications. I've never given advice. So that makes me perfectly suited to running a national wealth management business. But
is that your disclaimer early on, Lee?
It is. But that catchphrase 15 years on is getting a little bit worn. I think I need to own the financial services space a little bit more than I have done in the past. But yeah, I mean, my background is ostensibly in kind of tech and e-commerce. So at university, I studied mechanical engineering, but then decided to take all of my electives in the business school for no other reason than that looked a little bit more interesting. My dad always ran small businesses, nothing particularly successful, but it probably instilled in me that doing something on your own is nothing to be scared of.
What sort of businesses did your dad have?
He managed rock bands, he had a mobile bakery, he had a motorbike shop, pretty fun stuff. Yeah. I mean, never made a single penny, but it was more the case that, the concept of trying to do something is nothing that you should shy away from, So, nice. So I left university with the weirdest qualifications you've ever seen. So mechanical engineering and half the units on the business school, and decided at the start of 1998 to set up an e-commerce development business. And purely by luck, more than anything else, fell into delivering a range of solutions for small banks, building societies. That then was a springboard into working with some life insurance companies, some fund management houses. So quite a broad spectrum of work, doing quite a range of projects for these corporate clients.
How old are you at this point?
I was 22, 23.
Oh, okay.
And through that work, a lot of the stuff that we delivered, a lot of the tech solutions that we had to roll out had to interface with an IFA firm or a wealth management firm. And that was an unbelievable learning experience, because what I saw were a couple of things. Financial advisors and wealth managers sitting in front of clients giving advice are absolutely excellent. They're great at that client care, the whole advice, the whole service, long-term planning stuff. That's what they do best. But the businesses in which they worked were so clunky, so archaic, they had no business model. I thought, how do these firms make money? And that got me really interested. And the more work we did as a supplier into the FS sector, the more interested I got. So I decided to sell that business in late 2006 to the wrong people at the wrong time, but that's a learning experience in itself. And spent all of 2007 thinking about, okay, can we create a new model wealth advisory business? So one that has probably two aspects to it. An operating platform that can create organic growth, so really good at customer acquisition, good at tech, good at centralization, remove all of the risk and reg overhead from advisory firms, centralized diligence and fund research, all that kind of stuff. So can we enable financial advisors to do more of what they do best? And then secondly, can we create a buyout model which actually works? There's lots of research around the place that shows that M&A, classical M&A, really doesn't add value. And if you want to create a business of scale, M&A, is typically one of the things that you will look at. But just doing it the same way that everybody else has done it didn't seem particularly interesting. So they were the two aspects.
Just to cut across you there, so I'm going to jump around my questions a little bit here. For the benefit of those listening, you've done an extraordinary amount of M&A. And I know that you term your M&A strategy and the way that you run that process as that downstream buyout model. Do you want to just explain then for those people who are listening, not every part of the secret sauce, but what is that model? How many deals have you done to date? And obviously that'll jump around a little bit, but we'll pull that together. So go on, your M&A strategy and the volumes that you've done.
Our downstream buyout model, which we launched in 2010, so 2 years after we actually created the business. Firstly, it's probably the smartest thing that we've ever done, and it really has been the bedrock of our growth. And in very, very simple terms, it's a reversal of the traditional buy and build process. Typically you'll see firms who want to be acquisitive. They'll go out there, they'll find some firms that they want to speak to that broadly fit the profile. They'll do some due diligence, they'll agree a deal and think that the job is done. And my thinking was always, well, actually it's the integration that's the hard part. Mm-hmm. Where all the secret sauce is not in buying businesses. Buying businesses is really easy. Don't let anybody tell you different. Integrating businesses is really hard, and particularly making one cohesive business out of a range of entities that acts as one business and has real organic growth. That is really, really difficult, but that's the ultimate aim. So the downstream buyout proposition really reverses everything. So it is ultimately integrate, grow, acquire. We integrate a partner firm over 2, 3, 4 years. We provide them with the tools that they need to reach their aspirational performance levels, whether that is access to new customers, greater capacity, more time to actually spend with clients, whether it's the capital to grow, invest in the business, recruit, and we give them a great client proposition to work within as well. So we help them to grow over that integration period. That integration period is dictated by that partner firm, and really it means, okay, how long do you want to grow your business? And then we acquire after 2, 3 or 4 years, but based upon the level of financial performance at that time. So we incentivize growth, we get the hard work done first, and it just works. And I think one of the other aspects is when we buy the business, the deal doesn't end. It's a sell and stay proposition. Yep. We don't want the human capital walking out the door as soon as we've culminated the deal, but also we share the upside. So if that business continues to perform through the earnout, we share all of the upside.
Yeah, and it's an important part to sort of to pause on and stress there, isn't it? It's that realization doesn't come day one. Partial will, obviously, but it's the growth and it's that integration, and then X amount of years down the line is when everybody can then benefit from that initial transaction.
Yeah, and the emphasis within our business is firmly on that integration piece, and we can evidence that there are 12 people in our M&A team, there are 55 people in our integration team, and I think that says a lot.
How many have you done acquisitions to date then?
We've done 64 downstream buyout deals. Of those, we've acquired 56. So there are 8 that we will acquire the remaining part of this year through next year, maybe the early part of the year after. And we typically onboard around about 10 to 12 new partner firms per year.
And will you continue along that strategy going forwards? Will that always remain a core part of the strategy?
Yeah, it's nothing could tear us away from that strategy. We've proven time and time again that it works. And we publish some of our stats. Elsewhere in our sector, you see other M&A programs where they those businesses proudly kind of state that the firms that they've acquired have received 70-75% of their target sale value, which is, I just think that's crazy, actually publishing that, but that is the fact. And because most deals in our sector are done with an earn-out component. When the integration actually happens during the earn-out, that's the worst part of it, going through business disruption. And I think ultimately that, combined with a lot of acquirers operating vertically integrated models, forcing increased fees and forcing reduced choice upon clients, which then ultimately results in people leaving and clients leaving. That whole model doesn't work. I mean, that whole consolidator model, I just think it's looking through the wrong end of the telescope. And we're trying to be the exact opposite of that. We don't seem to be able to avoid the trade press calling us a consolidator, but we believe we're the exact opposite of that. When we publish our statistics, I'd like to think that backs up everything that we say. 100% of all of the firms that we've acquired have received 100% of their target sale value. Which again, a lot of people would think, well, isn't that commonplace? No, it's completely unique. But on average, the firms that we have acquired have received 116% of what they expected, and that's a result of continuing to share the upside that comes from increased performance and that whole sell and stay proposition. We want the selling shareholders and the principals to stay with the business, and we need to incentivize that, and we need to share the glory with them.
I'll change my introduction from consolidating business first.
Please don't. Honestly, we hate the term. We really don't like it.
No, don't worry. Right, I chopped you as you were talking around the journey. In my introduction, I do describe Fairstone as offering intelligent wealth management. Just explain that sentence for me, and then again, for the benefit of those people who are listening that aren't necessarily plugged into the sector, just summarize what Fairstone do.
Okay, so we really believe that it can be high end and low cost. So our offering is chartered, whole of market, and independent. Yet when you compare ourselves against the incumbent market leader, we deliver that service at 60% lower cost. Right. So that's a bit of a standout. But then I suppose if you go a couple of layers deeper, we really believe in long-term financial planning, lifetime cash flow planning plus estate planning, not just advising clients around certain products, but really giving them a track to run on to achieve their lifetime goals. Added into that, we have no minimum wealth levels. If a client comes to us with £5,000, we will work with them and we'll grow with that client. There are no exit fees. It's just a much more modern and a much more open architecture offering.
Nice. Since I've known you, Lee, you are one of the most successful businesses that I've come across. You've completed 2 rounds of private equity, which most people will maybe do one turn and then look at a trade exit or maybe public markets. So you're now on your 2nd round of private equity so far, and there may be more in the future potentially. Help me understand what has been your experience of working with private equity. Has anything changed in terms of what you perceived private equity to be or behave like? What was it like bringing a private equity sophisticated investor around the board table? For people who were listening, we have many CEOs listening to this podcast who may be contemplating private equity. Just give us your experiences from that particular process and how it's worked for you.
Yeah, I think the key differences are, from what I expected, probably I thought that working with private equity, having them in the business as a shareholder and around the board table would be more onerous than it actually is.
Okay.
I think if you are a business that has got really good MI, because private equity feeds on data, that is what it is. You've just got to get comfortable with that. But if you've got good MI, a good business intelligence platform, then actually the engagement with private equity is really quite simple. And for a business like ours, which is high growth, fast paced, quite entrepreneurial, private equity is a much better it's a much better funding structure and a much better business partner than being on the public markets. So that's the first thing. And I think we've gone through 2 rounds, and those 2 rounds were very different, and they were for very different purposes. So in 2016, when Sonova came in, the purpose of that round was to give more firepower to our acquisition program, so it was development capital, and to cash out some of our very early stage investors, because from the start we bootstrapped it ourselves. We invested all of our own money. Then we brought in some kind of high net worth syndicated money around about 2010. So and across into 2012. So by 2016, it was the time to give a liquidity event to those shareholders, and they got, they received a very good return on their money. And then in 2021, the deal with TA was really to start to scale the business and say, okay, we built a business of substance, but now can we build a business of true scale? And very different styles. The 2016 round, we were active in the market. We did a very small off-market process. I think we spoke to about 6 PE houses. We ended up with three offers, and we picked Sonova because they just understood the business to a far greater degree, and the level of work that they put in to the process. Meetings in Newcastle before any meetings in London, spending time with us and really getting underneath the model, the whole ecosystem in which we operate, competitive advantage against our peer group. It gave us a lot of confidence that they're going to be a really good business partner, which they have. But in 2021, when we completed the deal with TA, they actually approached us. So we weren't looking at the transaction. So I think it was September 2020 when they made an approach. And it was probably 12, maybe 18 months before we planned to go into another transaction. But everything worked. We like the approach. They understand financial services. They've got investments in the US. They've got investments in the Nordics. They're big believers in the wealth management space. So yeah, we felt very comfortable, and it avoided a whole prolonged process and all the things and all the distraction that comes with that further down the line. So very different processes, different reasons for raising capital, and interestingly, we still, clearly TA are now our lead investor, lead shareholder in the business, but Sonova also chose to reinvest. So took a return on their money and reinvested. And across the 2016 and across the 2021 private equity rounds, we delivered a return to our investors of anywhere between 4.5 times and 11 times their money. So, I do feel very proud of that.
Yeah, no, you should, and you have done a remarkable job, and you continue to. Just to touch on that, then. So your first round, you run a small process, as you say. You would have, and you'll always get inbound. You'll get inbound from advisors, and you'll get inbound from trade and private equity, etc. But you almost had the doors open a little bit to see what that looks like. When you get somebody coming in, and like I said, I appreciate you will always get inbound, but when TA then come in around 2021 and you realise this is a serious conversation, how difficult is it for you as a CEO to get your head around, okay, this isn't necessarily a welcomed approach in terms of you weren't looking for it, to then how quickly do you get to a position where you go, right, okay, we're comfortable here? How difficult was it for you to manage that? Whereas one was a process that you almost had control of and you knew where it was going to end up, and another one comes out of the blue.
Yeah, it's kind of the difference between speed dating and a marriage.
Carefully.
Yeah. I mean, we skipped the whole first date engagement, getting to know you, living together piece. But I don't know, sometimes you've just got to grasp the opportunity. Okay. They came to the table in a very informed way. I'd had you know the score, Paul. I've got different private equity houses pick up the phone every 2 or 3 months. Want to do a little bit of fact finding, and part of the art of what we do is just repackaging public information and letting people know what we're doing, what the outline plan is, everything that all information that's out there anyway in press announcements and annual reports and corporate collateral, but just forming a relationship and giving people who could be in the mix at the next transaction some information packaged up in a way that they wouldn't necessarily be able to assimilate by doing it themselves. So I actually spoke to TA, in one of these calls, probably 12 months prior to them coming to the table. And from that call, they'd obviously done a huge amount of background work. So they came in a very informed way. So that was pleasing. And two, I think the comfort that we could get from their investments, and very, very successful investments, with the likes of Soderbergh in the Nordics. They've invested, so they had a fantastic return on that business, and then reinvested recently again, and with businesses like Wealth Advisory Group in the States. This wasn't new to them, and you ask all the difficult questions as much as you can in the limited amount of time that you have to meet up in person, but it just felt right, and so far so good.
And whilst maybe a naive question on my part, is there an element of that? It sort of feels right. The gut feel does also come into it in terms of how those relationships and conversations have gone.
100%. Some of it's an art and not science. It's very much similar to when we're looking at which firms we want to partner with in the buyout program. It's not just about the financials. It's not just about the regulatory record. It's about, can we work with these people? Do we feel comfortable? Do they share the same values? Do we think there's going to be a good cultural fit? Whether it's PE or acquisitions or hiring of people, it's the same stuff, because it is a partnership, and you're going to go through good times, bad times, highs, lows, great market conditions, poor market conditions like we're in at the moment. And it's the strength of the relationship and the depth of understanding of what you're doing that's key. There's loads of money out there. I mean, there's just mountains of money out there, but it doesn't all come in the same form. So it's picking the right partner. That's the key point.
Well, thank you. Appreciate that. So given that you have acquired so many businesses into the Fairstone platform, where's the challenge in maintaining organic growth as well? And does the increased scale, obviously it does bring benefits. So what are the benefits then to the increased scale? So how do you manage and how do you keep the organic growth on? And then how does scale bring you advantages?
Yeah. So, I mean, organic growth really is the acid test. That's the acid test of a really good growing business, because you can continue to buy, but what you want is a business that can grow under its own steam. And thankfully, if you look at our KPIs, we have organic client growth of anywhere between 8 and 9%, pretty much consistently each year. And that's probably a function of three things. One, we are very, very good at customer acquisition. So we have a search engine based customer acquisition model, which leans on a lot of what I did in my previous business. And it works fantastically well. We create fantastic client opportunity with clients who have average investable assets of around £500,000 at a cost per acquisition point of sub £500. And that is, it's a mainstay of our business. It's something that we don't shout from the rooftops about, but it really is a fantastic tool to be able to provide to firms to say, okay, do you want to increase your client base? Do you want to segment your client base and look at a different way of servicing those clients with less sophisticated, simpler needs? So that's one aspect to it. The second aspect is the whole capacity thing. Yep. And we rarely find a firm that will say, I have too few clients. We very often find a firm that says, I'm struggling to service all of my clients. Yeah. And that's where and that's where all of the centralization stuff comes into play. So centralized power planning, centralized annual reviews, which clearly is very time consuming, because annual reviews are very different now than they were a few years ago. It's a full-blown suitability process to make sure that client risk profile, client portfolio, all of that stuff is still in the right space for the client. So how much of that can we take away from firms, but also can we provide a better, lower cost advisory channel to those clients who may not need full-blown wealth management services? So we launched our mineral proposition this year, and that's all about delivering very simple remote advice to clients that do need a full advisory solution but don't need the full service wealth management offering. So typically aimed at clients with simpler needs, probably smaller portfolios, or clients who are early stage accumulators. So they're building wealth rather than preserving or growing wealth. And to offer that to firms as a way to kind of incubate certain client types, it is a real tool in creating that additional capacity, which we can then infill with new customer opportunity. And then the last aspect is just releasing firms from, probably 30 to 40% of their time that they would historically have applied to risk, reg, compliance, CPD, training, all of the stuff where we can leverage our scale in those areas. We've got teams of people that can take care of that. And it's those three things kind of hanging together: new customers, capacity, and taking away the stuff that we're really good at, but small firms might not be so good at.
Yeah, well, it's just too much of a headache or pain in the proverbial, and actually you can provide the solution as well as the upside. COVID. I'm always interested to see how people responded to COVID. People being CEOs, owners of businesses, etc. Knowing how you engage with your customer base, I'm assuming that would have been a hell of a challenge to begin with. What was the impact of COVID? How did you change both operationally and management wise? And have you come out the other side thinking, have you got a new business here, or are you now going back to some of the tried and tested ways previously?
Looking back at it, none of us would ever choose to go through that period again.
No.
But I'm astonished at how well we performed. And at the start of COVID, we did a reforecast because the market tanked, and we had to then reforecast 4 times across the year because we beat each forecast that we put in place. And the things that we didn't do many things, but the things that we did, I thought, we executed well. So number one, everybody within the business, barring maybe a handful of our colleagues, they were already set up to work from home if needed. So other than an emergency purchase of 20 odd laptops, everybody already had full setup, full firewall access, could access.
So you were quite agile anyway.
Sorry.
So you were quite agile anyway.
Yeah. So that flip to remote working took us a couple of days. So that wasn't something that was a huge burden. We did have to put in some new tech, so we very quickly put together what we call our zero-touch tech platform. So that replicates many aspects of the face-to-face application. As we're speaking today through Teams, but with Adobe Sign and with some kind of more dynamic illustration stuff and screen-to-screen document sharing and all that kind of thing. So we were able to replicate, our service offering through tech, and again, surprisingly, that landed unbelievably well, and we still use it today. So a lot of our clients have become more comfortable being serviced, annual review or at various different touch points.
Has that made it harder to convert clients, or does that make it easier for competitors to penetrate, or is that not really relevant?
So we don't really use it to win new clients, because I think it's a step too far. If you're talking about significant sums of money, to win a new client and gain the trust of that client and all the things that you need to just through a screen. But for managing existing clients in a much more effective way, it's a great tool. But that landed really well. And then the last aspect was just comms. We went from doing monthly investment updates to weekly investment updates for our clients, just to show that we're on top of things, just to show that we're aware of everything that's happening in the world. We're mitigating risks wherever we can, encouraging clients not to crystallize a loss because markets will come back. And that was key. And also internally, we spent a lot of time doing just fireside chats. So 6 o'clock each night with different cohorts of our colleagues, with a glass of wine, a beer, or a cup of tea in hand. And the rule was we can talk about anything, but we can't talk about work. So we did yellow card and red card. If you talked about work once, you got the yellow card. And if you talk about work twice, you got the red card. And we just did lots and lots of that stuff because, you know, it was scary. You know, people, it feels like a lifetime ago, but it wasn't. It was only 2 years ago. In the early days, it was scary and people didn't know what was happening. So just staying connected, engaging as much as we can. And it was tiring. You know, you'll know exactly what I'm talking about. Every day was just Teams meeting after Teams meeting after Teams meeting. Yeah. And a big part of the job was just being, you know, the positive voice in the room. And, you know, you become part CEO, part court jester because you just need to keep spirits up. But we got through it, and we got through it in fantastic shape. Never, ever would I have thought that we would get through COVID with the, you know, the level of financial performance that we did, in the shape that we did, and it did actually bring parts of the business a little bit closer together. So strange.
And look, people can always appreciate when I ask that question. You know, we like to think that we talk to really successful businesses and that sort of stuff. But you then secured another private equity round sort of during that period, slightly after it. So therefore, the proof's in the pudding in terms of, you know, what you are saying is, you know, there is evidence that actually the business was performing exceptionally well. So, you know, I appreciate that it's not just you saying those things. Right, I'm going to delve into areas that are far more educational and intelligent than what I am in terms of macro and governmental, but I do feel that they are important for a business like yours. So as we speak today, Lee, we're heading towards the back end of November. We've just come through, I mean, quite frankly, a crazy period. Politically, I don't know, 3 prime ministers in as many months, that kind of thing where, you know, it's just bonkers, isn't it? And there'll be a period of, you know, in the future when they look back and say, what the hell was going on in the UK over that period? What does the macro environmental changes and challenges, and I'll also weave another question in. So you've got the political instability, and then our current economic changes. So the Bank of England have recently raised interest rates. How does that affect a financial services business like Fairstone on a day-to-day, and how you pivot? So you've got big changes from a prime minister perspective, changes in interest rates, inflation, etc. What are the impacts for you?
The impacts for us are probably a couple of things. One, clients just don't know which way to turn. You know, so again, you know, pretty similar to the whole COVID experience. A big part of our job just turns into one of reassurance and trying to avoid, you know, trying to encourage clients to stick to the long-term plan, understand that markets go through upturns and downturns. You know, history tells us that the upturns are far longer and far more lucrative than the downturns, all this kind of stuff. But because there's been so much volatility, and if you look at the backdrop across the world at the moment, you know, you've got coming out of COVID, you know, so we have to fund the cost of the Second World War effectively. You've got Brexit, you've got war in Ukraine, you've got, you know, energy bills going through the roof. You've still got pressure on fuel prices as well, and then rising interest rates and all this kind of stuff. There's very little solid ground for clients just to, you know, without any external guidance and advice to know what to do.
Away, is there?
Yeah, so the job of, you know, the job of a wealth advisor then becomes the flip side to the, you know, to the bull market, which is it's reassurance, it's sticking to the plan, it's looking to manage costs wherever you can for clients, looking to minimize volatility, looking to bring in other assets. You know, interestingly, cash is coming back as an asset, which nobody's seen for the best part of 20 years. So it's the same set of skills, but just applied in a different way. But it's a strange one as we sit here today. I think in 50 years' time, you know, school kids are going to be taught about the last few years and the next few years as kind of the age of volatility or something like that, because there's just been so much. But really, it is the time when financial advice really should come to the fore. And because, let's be honest, when the market goes up, we all do fantastically well, clients do fantastically well, but we don't have to work a lot harder for it. You know, let's be honest about that. Yeah. The time where we really earn our corn is where we do go through periods of instability and volatility. And there's no point complaining about that. It just is what it is. And, all we're looking for as a business, and if you ask anybody else in my position, we're just looking for a bit of stability.
Please.
And actually from government, I think it's less about which way you lean politically, and it's more just now, please give me competent government that will make sensible decisions, because that's what we've lacked. We've lacked that entirely. Now, I'm a little bit optimistic about what 2023 will look like, a little bit optimistic. I think markets have steadied a bit. Interest rate swaps are coming down. There are certain indicators that inflation might be getting under control. But all we're really looking for is stability, because people can plan when there is stability. There comes a point when in any down market, it becomes a buying opportunity as well. But, the worst thing that we can try and do is time the market. We need various economic indicators to be going from flashing red to at least flashing amber before we can say with conviction, now's the time to be in the market and now's the time to do braver things. But I'm an optimist by nature, and I'm cautiously optimistic about what next year will be. I think at the very least, it will be more stable than the last year has been.
You do know this isn't a private conversation, Lee. We are recording for a podcast, and this will be released, and maybe at the back
I
end
will be putting out the disclaimer that none of this is financial advice and does not represent the views of Fairstone Financial Management.
Correct. Or Lee Hartley, yeah. So with that in mind, then, and revisiting your M&A strategy, does that bring further opportunity for you?
It does, and the benefit of what we do and how we do it is, we can look through periodic blips in trading performance, because we've been working in partnership with our partner firms for 2, 3 or 4 years. So we've got complete transparency over their underlying performance, and that means we can continue to buy exactly as we had planned, because we know what that business is capable of. We know what the fundamentals of that business are, how many clients they have, what funds under management they have in normal market conditions. So if that was somebody that we just met for the first time, you'd probably start having the conversation around valuation, performance, and trying to mitigate some of that stuff. We don't have to have those conversations because we know how these businesses perform, and that is a huge advantage. By the same token, we also offer our partner firms some real, tangible flex points in the deal structure. So if they decided that now's not the right time to sell because the market has hit their performance and they think that might, extend for a year or so, they can push the acquisition point out completely at their discretion. And also, if during the earn-out, if the market's tanked and their performance took a hit, they can actually pause the earn-out, move it to the right, and say, listen, I don't want to effectively say to clients, don't crystallize a loss in a downturn. The same thing with our acquisitions. Move the earn-out to the right. Don't crystallize, a smaller earn-out payment, because we want every single one of the firms that we acquire to get the maximum value from their business. And by doing that, the hope is that those shareholders will stay with us for the long term, continue to grow, continue to be incentivized, and really be part of the culture that we're trying to build.
So you've bootstrapped the business, you've done 2 private equity events, 60 odd, 64, I think you said, M&A transactions. An exit, what does that, bear in mind that you're in your future gazing mode, what does an exit look like for Fairstone?
Firstly, I think we're lucky enough to have backers that really do not think short term. Now, every single private equity firm on earth will say, we're longer term holders and all this kind of stuff. But
you've been consistent with that. You've said that repeatedly to me. Yeah.
But for us, I don't think we're going to be looking at another liquidity event for another 5, 6, maybe even 7 years. For our shareholders, I think their appetite is to really see the business reach its full potential. And there's a range of things that we're doing now around strategy that are going to take a while to roll out. They're going to take a while to create value, and we want to see those things, in full flow before we look at another transaction. So from a timing point, I think it's 5, 6 or 7 years from here. We are, I think, because of the nature of the business, we're very well suited to private equity. My best guess is that we'll go through another private equity transaction. But you can never say never. A listing, as you know, entirely dependent upon the weather, entirely dependent upon the market conditions, and making sure that if you are looking at a listing, you probably, you'd want to run a dual process anyway. But it's not beyond our thinking, and also because of the nature of our business. There aren't many organisations that can quite accurately predict what their P&L contribution will be from M&A in 2 years and 3 years and 4 years time.
Good point. Yeah, good point.
Where we can. So, there are aspects that could be attractive to the public markets, but I just think because of the entrepreneurial, high growth, fast paced nature of what we do, that I think remaining a private business is probably the most likely outcome for us.
Whilst I've got you, and I've got you on future gazing mode again, before we start winding up the pod, back end of November 2022, we've done one World Cup match so far. So England beat Iran 6-2 on Monday. I know you're proud, Geordie. We're not going to get into Newcastle United, certainly not going to get into Everton, my team. Where do you think England will get on in the World Cup?
I think we'll do pretty well.
But you are confident, you said before. Okay, right.
I am confident.
Is it coming home, Lee?
Do you know what? It could. I think we've got a young squad, loads of energy, massive creative talent. I think we're going to do pretty well. I think we're going to at least get through to the semi-finals.
Wow. Okay. That's well, look, and you've got a couple of Newcastle players in there, haven't you? My old next door neighbours in there. You've got the right back. So he's okay. Semi-finals are punchy. I think that's ambitious. I think they might struggle actually, but I can't get too carried away for 6-2 win. But let's see. Right, last couple of questions then, Lee. I'm very conscious that you've got a busy day ahead of you. So, I like these questions as well because I think they bring out a bit more of a personal insight into those people that we sit down with. Any walk of life now, so don't worry about trying to be really clever or educational based, whatever it may well be. Who is your icon?
Ooh, that's a tough one.
Could be anything. Could be football, business,
do you know
music,
what?
anything.
I'm going to avoid the temptation that a lot of people take when asked this kind of question. You come up with some really cerebral answer. I'm going to go with Dave Grohl, ex-drummer of Nirvana, lead singer of the Foo Fighters. I think he is the saviour of rock and roll.
Have you read his book?
I've read his book. I've seen them 6 or 7 times. Before they cancelled their tour for very obvious reasons this year, with the death of their drummer, the plan was to go and see them on every single date in the UK.
Really?
Yeah, absolutely.
Wow.
I'll go anywhere for a band with 2 guitars, a bass, and a set of drums.
Okay, so you've obviously got that from your father's one of his businesses running the rock and roll, whichever band that was. I think if you grew your hair out a little bit, there's a bit of Dave Grohl in you actually.
Well, I am a bedroom rock star. It's never been on stage, but the talent is there.
Dave Grohl, I like that. Not on my sort of top list of foos, but I'll give I can definitely listen to them. My kind of genre though. Probably a bit more of a cerebral answer then for the next question. If you could go back in time and go to I can't remember what age I did ask, just so sorry, but a 22-year-old Lee Hartley who set up his businesses and maybe didn't quite know what the future path was going to look like and had different concerns at a different point in time. What would you say to your younger self now, knowing what you know, sort of where you are today in 2022?
Couple of things. I think So there's a phrase I use, actually, and it's a phrase that I stole from one of our very early stage investors that I really try and live my life by, which is, I've spent my life dealing with bad news in different forms and at different times, but what I hate are surprises. And just trying to make sure that people, if something is going wrong in the business, making sure that they always come to the table early. Because if you come to the table early, it's our problem. If you come to the table late, it's your problem. But just really trying to get that principle established very, very, very early into the business. That's one thing. And it's all about people. And it's all about the quality of the people that you surround yourself with, the quality of the people that you hire, whether they share the same cultural values. The mistakes that I've made in hiring have always been when I've been seduced by the CV, seduced by the glitz and glamour of past experience, and forgot about the person. And it really is, it's just all about people. It's about building a team, having a team that want to work together, will go the extra mile. Strategy is great, and you've got to have strategy, you've got to have differentiation, you've got to have a plan that you stick to and work at and prove and refine. But the precursor to all of that is, it's just all about people. So spend as much time as you can finding really great people that you want to work with, and spend as much time with them as possible, making sure that they really understand what you're trying to achieve. And things tend to just work out if you do that.
Right. You've been very kind enough to invite me to your conferences in the past. I know you are a very elegant public speaker, but genuinely, I love listening to you talk, I think. And I never leave a session with you without a smile on my face. And I've really enjoyed that time we've just spent together. And hopefully people listening to that will learn a little bit about Fairstone, but actually learn a lot about how to just make the right decisions and actually trusting your gut and believing in people and just being honest, really.
Thanks, and you got the benefit of my weekend accent rather than my affected Monday to Friday accent as well. I thought I'd give you the full experience.
Good man. Lee, thank you.
This content is issued by Zeus Capital Limited, which is authorised and regulated in the United Kingdom by the Financial Conduct Authority for designated investment business and is a member firm of the London Stock Exchange. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this podcast. The views expressed in this podcast are those of the participants and not of Zeus. Please note that participants in this podcast may have financial interests in the matters discussed.